and also in regards to the housing market as well. Not only the Vegas housing market, but also some of these federal laws that's being passed, and actually some may be afraid of. So I know we're dispelling some of those myths, right?
Absolutely, absolutely. Yeah, yeah. We can get right into that one. Cause man, that's one that's definitely been grinding my gears. A lot of people have had questions about that. Even some of my family members, right? And as a real estate professional myself, they're telling me what they're hearing on the news and this and that. And I'm just like, hey, I do this every day, right? So I'm not gonna give you the wrong information. One, because that's not what I do, and two, because I kind of love you too. You're my family now. I'm gonna make sure you're gonna be all right. So, yeah, there's a lot of political jargon going on, and I think jockeying for position because we are going into an election year. So there's some controversial stuff going on with the new policies in regards to interest rates for
Mhm.
government funded loans. Okay, so they haven't really. There haven't been a lot of information on how this impacts the VA loan. They've been mostly talking about it from the sense of the FHA loan, but I imagine because those are both government programs, it probably impacts both of them as well. And it actually just impacts all mortgages because, it's just the risk assessment of loans. Okay. So what's being floated in the news right now is that people with lower interest, people with lower down payments and lower credit scores are actually going to be able to save money on their mortgages, right? So they're talking about President Joe Biden has came out with a program that actually helps low income individuals get into housing. That's what that program was meant to do. But in doing so, they're talking about is penalizing individuals with higher credit scores. So, for example, if your credit score is like 740 and in that kind of mid to higher 700s, there are certain circumstances where you're actually going to be paying more for your loan as far as more in your interest rate because of that and because you have more down payment. Okay, so that's what they've been talking about. And again, that's just been political jargon and making news headlines. But I just want to dispel that right now. It's totally false, Kenneth. So we want to let the people know that that's totally false. It's kind of like when we were in statistics class back in the day, right? Math class and
Mhm.
different things like that. When you're talking about stats, you could kind of bend the information to make it seem like whatever you want it to be, right? When you're looking at statistics and you're creating polls and stuff. And that's exactly what they did with that information.
Mm, mm. So yeah, I just want to kind of unpack that a bit, right?
Absolutely.
Because again, we're talking about when we're talking about credit scores. Obviously, that's kind of where again we in a VA home loan space, right? They kind of throw away credit scores, but you're saying that in with FHA, VA, whoever, this may impact the kind of government space, what have you, right? So.
Absolutely.
Uh,
Absolutely.
so with that, and again, and correct me if I'm wrong. So you're stating that if you have a lower credit score, that you'll have the availability to be able to have a higher purchase, or what in general? I mean, what specifically?
Absolutely. So that good question. I mean, technically you would have a higher purchase, right? Because they're saying individuals that are using the FHA loan that have maybe a 640 credit score and they're only putting down that minimum 3.5%, or even if they're using a 5% conventional loan product. Um, it doesn't matter which loan product they're using, but we're going to use the FHA loan as an example. Those individuals are going to basically receive a, a supplement for their interest rate. So basically, when they're giving out an interest rate, they're looking at a certain chart. Okay, so they're kind of charting things based on your down payment and your credit score because they're looking at the risk factor of giving
Hmm.
you that loan. So typically you would think, hey, I don't have as much down payment. My credit isn't that good. I would probably have a higher interest rate because of that. So what they actually been doing is that it's like, no, we're going to give you some, we're going to give you a lower interest rate because you have a lower credit score and less down payment. That's how the chart has been working for the government. So,
Hmm.
like, let's say, for example, if you have a that 640 and you're only putting 3.5% down, you might get a 6% interest rate, right? When somebody with the 740 and 15% down, they get in, a 6.5% interest rate, right? Just for just random examples. So it's like, they're like, man, what's going on? Why am I being penalized for having a higher credit score and putting more money down? I shouldn't even, should I just do something to lower my credit, or whatever like this, right? And I just want to let people know that's not the answer, because for a split second when I thought this was true, I thought about doing that myself. I was like, oh, let me just run up some credit cards real quick before I buy another home to lower my credit score, and then I'll take advantage of those payments as well. But it's really nuanced on why that happened in that particular scenario. And what the news headline did was, it was just that one particular situation where that happened, and they took that example and they ran with it and said, oh yeah, everybody with higher credit scores are being penalized to pay for the low income people, right? And that's just not particularly true, because when you get down to it, that same person that was receiving an interest rate of 6.5 when they were putting 15% down, if they changed that equation and only put 5% down, they would have had a lower interest rate than the person with the lower credit score. So what happened was that their down payment being in that middle tier made the loan more riskier. And I can go into that, and I know it gets into the weeds, but if you're putting less than 20% down on a loan, okay, you have to pay mortgage insurance, right? So the way it's working is that the lower your down payment is, the more that the government or the mortgage insurance will guarantee for that loan. Okay. So they'll guarantee more on that loan with the lower down payment, because they know they have to be able to get that loan funded. But when you're putting 10% down, you're just 5% from the 20% minimum down payment to not have mortgage insurance at all. So that mortgage insurance isn't guaranteeing that much based on if you default, right? And that's why putting 15% down is not a good thing, right? You either want to be lower than you want to be 5% down conventional if you're using a conventional product, or you want to be 20 or more. If you're in that 15%, you're putting 15% down, you probably want to just keep that money and utilize that to improve the home. You can utilize that to buy down the interest rate even further, right? And different things like that. So that's why it's always important to have a great realtor and loan officer, right? Because having a great team of real estate professionals, we're going to look at that and say, hey, this doesn't sound right, right? And see what we need to do to get you that best available rate, okay? So again, it's always important to work with competent professionals, and it's definitely always important to double check what you hear in the news, because they're only giving you a headline that's not painting that full picture.
Yes, sir. Yes, sir. It definitely sounds like as we continue to carry on, that a lot of this stuff is going to unravel with education, right? When you're working with subject matter experts, is, again, it's so much false news that goes out on a 24-hour basis. You kind of want to dispel that. So thank you for that, kind of unpacking that, because again, I thought about going out buying a boat myself. So just run the credit up, right?
Yeah, just run the credit up, man. And that's what people were thinking. And it's just like, you have to think about it. And even when you think about the government loan, and as we know with the VA loan and the FHA loan anyway, you're not just looking at the interest rate when you're looking at those products, right? You have your the funding fees for those. Both of those charge a funding fee, right? Where you don't have those on a conventional loan product, with the other individuals that were putting down that higher down payment. So it's just hard when they use those generalizations, because it's not an apples to apples comparison a lot of times. And it's giving people, kind of a false sense of reality on what's going on. Even when they're talking about the interest rates and talking about, oh, it's not a good time to buy right now. And it's just like, usually whatever the news is telling you to do, go in the opposite direction a lot of times, right? Because they typically are going to have an agenda, you have to always ask the question, why are they telling me this, right? And as we know, they're trying to get inflation down, which they're trying to get spending down. So they don't want you going out to buy a new house, right? Because they don't want you spending money. They're trying to stop inflation, right? And kind of stifle that. So that's why it's been like, no, housing is bad right now. But as you look at different hedge funds and as you look at different investors, they're still buying real estate. You want to be a lot more disciplined about it, but you're still purchasing.
Of course, of course. And I think also we touched on as well when we're talking about lenders just in general and also the credit score. It's also about credit worthiness, right? Are you worthy to take on this credit? And how you do so is that they're going to take a look at your finances as well. So if you do take your credit score just to be able to get the extra benefit of potentially being able to less fees and being able to purchase, you're going to also incur a debt to income ratio. So it's always, that's something to take account as well. So, and I think it kind of rolls into obviously with it being a government loan, being a viable government loan that the vendor can sell, right? So ultimately, I think uncovering that and making sure that the people know that where the kind of the news kind of leaves those loopholes for interpretation. But we want to make sure that we're uncovering everything.
Absolutely. And you brought up a real good point about debt to income ratio, because one of the other proposals that they're talking about is that actually charging people more when you have a higher debt to income ratio, right? That was part of the other kind of legislation that's coming down the pipeline, is that if your debt to income is over 40% or 45% ratio with the FHA loan, then they're going to charge extra fees and extra things with the interest rate on that. So it's like, in one side of the coin, they say Biden is trying to help low income people that are trying to buy their home for the first time. But it's like, well, they typically have a higher debt to income ratio as well. And that was the wonderful thing about the FHA loan. And it's the wonderful thing about the VA loan, where you're kind of throwing all those things out the water and allowing people to have a higher debt to income ratio and saying, hey, can you actually afford this property, right? And as we know, and as you just mentioned, being able to afford the property and qualify for the loan are two separately different things. And that's why you want to have this education like we're going to be doing in Las Vegas on May 10th. A little plug there. And we're going to be doing all the time, right? Just with Veterans for Veterans, we want to keep veterans educated on everything that they need to take care of themselves and their families, right? And understanding those different nuances is what we really specialize in, man. And that's really important. And we're really excited to kind of keep educating you guys on this. But the main point that we want to drive home is that no, you will not be penalized for having a higher credit score. That will not happen. That's not what's going on. If you are putting 15% down or 20% down, you want to have your lender look at different options for you to say, hey, what would my interest rate be if I only put down 5% versus the 10 or 15% or 20% that I was thinking about, right? So what you want to do is you want to ultimately have your lender run a few different scenarios that you may be comfortable with to ultimately get you the best purchase for your home. Okay, so that's going to be the best thing that you could actually do, because you may, again, be able to put down 5%, keep those other funds that you have in reserves, and get a better interest rate. And that's what we were seeing when we were comparing that to putting 15% down opposed to the 5%. Okay, it'll be better to keep those additional funds as a reserve.
For sure, for sure. Perfect.
Absolutely, absolutely, man. So yeah, we again continue to educate on that, man, and definitely reach down in the comments if you have any other questions about that. We are having some events in Las Vegas, like I just mentioned, and in some other places. So if you want more information on a particular level, our information is down in the comments there. And you want to schedule a one-on-one, we can talk more about it. But ultimately, if you feel like your questions could benefit the whole entire group, go ahead and just send that comment down so that we could answer that question and everyone could see that and everyone could benefit from that information, because we really feel proud about helping veterans and helping everyone with their decisions. And we're gonna keep doing that, man. So definitely send those questions on. We'll love to kind of unpack these subjects a lot more for you.
No, 100%, man. I mean, I'm really excited about this because these are spaces or a community that a lot of these questions they come up, but we're afraid to kind of dive into, right? Finances is one of those very scary conversations to have because most people aren't open about it. We want to talk about those things because, again, the more we're able to provide financial literacy, not to the component as we're financial experts or anything of that nature, by being able to provide you guidance in the real estate space, entrepreneurial space, and also the disability space. So I'm really excited about that. All right. So again, just as Kayvon said, go ahead and reach out to, again, comment, touch the people. Again, touch us. We'll definitely respond to you. And we want to make sure that we're being able to provide you valuable information.
Absolutely. All right, we're gonna get on to our next segment here, and we're actually gonna dive into a little bit of Kenneth Davis business here, man. We're gonna talk entrepreneurship and kind of talk about how he established Veterans for Veterans, and he's gonna give a lot of helpful tips for veterans that are looking to start businesses. So definitely tune in to the next segment. We'll catch you on the other side. Peace.